My name is Robert Wagonza, and I am the moderator this morning. In front of you, where you're seated, you have an information pack in this folder. And in that pack, you'll find the registration form. Kindly complete that form because we want to get to know who has actually attended this symposium. You'll also find the program which you are going to be following this morning is in that folder as well. And then finally, you'll find the Financial Stability Risk Assessment Report. So those are the three major items in that folder. So please make reference to them as we move along with this symposium. Please allow me to invite Nakasi Chiwanuka from the Bank of Uganda to lead us in a word of prayer. And Nakasi is the head of protocol, the chief of protocol at the Bank of Uganda. I'm sure she will welcome the many of us this morning. So thank you so much, Nakasi, for accepting to commit us to the Lord so that we start this symposium with our blessings. Over to you, Nakasi.
Let us humble ourselves for a word of prayer. Heavenly Father, we thank you so very much for this day that you have given us. We thank you for every single person who has made it here today to be with us, Father. The weather hasn't been very good, but people have tried to make it here at the invitation of the Central Bank, and we thank you. We ask you, Father, to please guide us in everything that we deliberate upon today. The people who are going to be presenting, Father, let them do a good job as they're presenting. And we ask everybody who's listening in, Father, that they take away something from this symposium, that they learn something from here, not something just for their benefit, but for the benefit of the Republic of Uganda in terms of what we're doing here. We ask you, Father, to be here to guide us in everything that we do. In Jesus' name we've prayed. Amen.
Thank you so much. Thank you so much, Nakasi, for that wonderful prayer. I almost wanted to give you another title this morning, Pastor Nakasi, because you've led us in the word of prayer very well. Ladies and gentlemen, without much ado, please allow me to now invite the Director Communications Department at the Bank of Uganda, who is none other than Kenneth Egesa, to come and deliver opening remarks. You're welcome, Kenneth.
Thank you, Robert. Good morning, everybody. Mine are not really opening remarks because our key speaker here is Dr. Titi. So I'll just welcome all of you and then invite our key speaker to deliver his presentation. So the Executive Director, Supervision, Bank of Uganda, the CEO of the Private Sector Foundation, the Director, Government Citizen Interaction Center, our colleagues from academia, management and colleagues of Bank of Uganda, the media fraternity, distinguished participants here and online. Ladies and gentlemen, a very good morning to you all. I am delighted to welcome you all here to the third Financial Stability Symposium. It is indeed an honor to have you here. I know that you could have been doing other things. We believe that this is going to be a positive and fruitful engagement. In line with the Bank of Uganda's objective to enhance stakeholder confidence, the key purpose of this Financial Stability Symposium is to increase awareness, understanding, and appreciation of Bank of Uganda's financial stability roles. The Financial Stability Symposium is a useful forum, not only to impart our message, but also to engage with you and to listen to the views of all of our stakeholders. In our previous engagements, the bank has received a great deal of useful feedback, which is continuously incorporated into the bank's strategic choices, but also allowing for continued learning and improvement so that we can serve you better. So it's for this reason that we shall keep conducting such engaging events to which your participation is highly appreciated. Let me take this opportunity to remind you all that in fulfilling our mandate of promoting price stability and a sound financial system, one of our core responsibilities is to supervise and regulate financial institutions that include commercial banks, credit institutions, micro-deposit taking institutions, forex bureaus. And the aim is to ensure that they conduct their business safely and make reasonable returns without engaging in excesses that could risk the money deposited by their customers or the stability of the sector. So as BOU strives to maintain the integrity of the banking sector, to ensure customer confidence, we need also to engage with you so that you are aware of what we are doing. At the helm of this heavy task is Dr. Twinemanze Tumuwaine, the Executive Director of Supervision, who's going to share with you highlights of key developments in the recent past, touching on the performance of the sector, the newest regulatory reforms, while also expounding on BOU's role in regulating the financial institutions. As you have already been informed, after the presentation, we shall provide an opportunity to take questions and give answers. And this is where I encourage you to give us feedback and ask questions related to supervision of the financial sector. Without any further ado, I now take the profound pleasure of inviting our guest speaker, the Executive Director of Supervision, to come and address you and make a presentation. I wish you good deliberations this morning. Thank you very much for your attention. Dr. Twina, you're most welcome.
So, good morning, everyone. The matter that brings us here today is to be appraised about the state of the financial sector in Uganda. In my presentation today, I'm largely going to focus on, like Kenneth indicated, just highlights and key features of the state of the financial sector in Uganda. So I'll start with a summary of the key risks, an overview of the banking sector, performance of the payment systems. I shall provide an update on regulatory developments throughout the year or to date, and then give a synopsis in terms of outlook and policy implications. The first part we shall discuss here, or I shall present today, refers to summary of the key risks within financial stability within the financial sector. Whilst there are very many risks, I think here what we've done is that we focus on those that we think are pertinent and critical to understanding financial sector stability. Overall risk, which is about systemic risk. Systemic risk is basically the risk of a collapse or a risk to the wider financial system as opposed to individual financial institutions. It remains moderate. And you'll notice that the color is amber, which is moderate risk, and the direction is horizontal, meaning that it is kind of stable. On macro risk, we still have lower inflation compared to our neighbors and other countries generally within the region. Yes. For macro risks, again, they are moderate and stable, largely motivated by the low inflation that we're experiencing and relative stability within the foreign exchange market. Liquidity and funding risk, this is for the financial institutions themselves. Liquidity and funding conditions have improved, partly due to the continued wearing off of the tight monetary stance that Bank of Uganda has maintained since the mid-2022. Credit risk, it's moderate, but potentially increasing. It continues, credit growth continues to recover. Non-performing loans to gross loans, the ratio has reduced. And the reduction in NPLs is largely because the financial institutions have been a bit more prudent in how they provision and write off non-performing loans. Profitability, in the aggregate, the capital buffers remain strong and resilient. And down during the presentation, I'll provide a bit more detail on profitability, but broadly across the industry, it's actually grown year on year from December 2022 to December 2023. Market risk, again, the exchange rate, the interest rates have largely remained stable. And structural risk, which is about the level of concentration or competition power within the industry, is good. When we look at the DSIBs, which is domestic systemically important banks, their share of banking assets has actually reduced from 61% to about 60%. Here are some of the composite indicators of systemic risk. To the left, you'll notice that largely the percentage changes in the period from December 2018 to December 2023 have largely remained within a bound between -5 and about 10. On the right, the figure indicates the level of systemic risk within the wider economy. Now, along the 7 dimensions of risk that we're looking at: liquidity, profitability, market risk, credit risk, market risk, structural risk. Those numbers indicate the risk level. So the higher the level, the higher the number, the higher the risk. If you will note, the dotted line is where we're at in December 2022. I don't know if that's yellow or orange. That yellow line, the yellow line now indicates where we're at as of December 2023. You'll notice that largely there has been a reduction in risk across all the major dimensions of risk that we concern ourselves about. The exception perhaps might be on credit risk, but even then, that is moderate. Turning to macro-financial developments across the globe. Estimates by the IMF and the World Economic Forum, inflation globally is expected to fall from 5.8 to 4.4% in 2025, compared to the 9.2% that globally was experienced in 2022. Financing conditions remain tight. Interest rates rose in advanced economies, and we have seen, as a consequence, an expected outflow of funding from EMDEs, emerging and developing economies. However, and that's in light blue, for Uganda, we've largely remained competitive, and total offshore investments have actually risen to 4 trillion shillings in December 2023, which is an increase of 1.5% when we compare December to September 2023, and 28% on a year-on-year basis. On domestic developments, GDP grew by about 5.2% in the financial year 22-23, from the 4.6 that have been registered in 21-22. And our projections at Bank of Uganda are that it will be 6% for 23-24 and 6.5% in 24-25. The financing conditions domestically remain stable. Following the slight easing of monetary policy, you notice we moved from a CBR of 10 to now 9.5. Core inflation has eased to 2.3% in December, compared to 2.4% in September, and 8.4% in December 2022. So on a year-on-year basis, inflation has actually dropped by almost 75%, from 8.4% to 2.3%. The exchange rate has remained relatively stable, with some marginal depreciation of 0.7% in the quarter ending December 2023, and year-on-year, the depreciation has been 1.8%. So the aggregate banking sector assets on overall have increased by 9.3% to 51.3 trillion in December 2023, compared to the 46.9% that was where the assets in the industry at the end of 2022. So the outlook or the implications of these figures are that with improving global and domestic economic growth and financial conditions, we expect support for financial positions of households, firms, and government, leading to better sector performance. Funding and liquidity. As indicated earlier on in the key summary risks, liquidity and funding risk is moderate. It is unstable over the period, and slightly supported by the increased holding of high-quality liquid assets by the financial institutions. Wholesale and retail funding deposits rose by 1.3% in the quarter ending December 2023. Funding costs, the average swap to CBR spread reduced from 2.7 to 1.22 over the quarter ending December. In the assessment of liquidity risk, the liquidity buffers have improved. Aggregate liquidity coverage ratio, which is the proportion of liquid assets a financial institution holds that enable it to cover 30 days of cash outflows. The aggregate has increased from 267% to 285% on a quarter basis. Because the prudential minimum is required is that we expect financial institutions to hold high quality liquid assets that at a minimum can cover 30 days of their cash flows. So that's the minimum, the prudential minimum is 100%. The aggregate liquid assets to deposits ratio increased from 44.4% to 45% as of December 2023. That was a marginal increment. Again, this is almost double the prudential minimum of 20%. So when you look at the action and outlook from Bank of Uganda's perspective, we have now started implementation of Financial Institutions Liquidity Regulations 2023, which will enhance the financial institutions' ability to manage their liquidity and funding risk. And second, from an outlook perspective, we expect recovery in economic growth and relative stability in the financial markets. And this, we hope, will further improve the funding conditions and liquidity conditions within the market. Credit risk. Total loans total loans grew on a year-on-year basis by 7.8%, by about 1.5 trillion shillings. This is higher than the 5.4% growth in the year-on-year for September 2023. However, it still remains lower than the 8.6 registered as of December 2022. And I'd just like to draw your attention to the figure on the top right corner, which just gives an indication in terms of what's been happening to credit growth over the period from when we compare year-on-year from 2018 to 2023. So credit growth largely, just looking at the long-term trend, it remains below the long-term trend, but not too significantly below. Asset quality has improved. The non-performing loans to gross loans ratio has reduced to 4.7% as of end of December 2023, compared to 5.4% registered in September 2023 and 5.3% as of December 2022. And again, like I indicated earlier on, this reduction is largely reflected in the more prudential write-off and provisioning for bad loans that are in the sector. The implications, so this improvement in asset quality is expected to encourage or increase the appetite of financial institutions to continue lending. And of course, naturally, Bank of Uganda, as the financial sector regulator, will continue to engage these financial institutions to maintain this path or trajectory of prudent credit risk management and in the mobilization of adequate capital buffers to absorb or to be able to be resilient to potential shocks to their capital. Capital adequacy and profitability. On the aggregate, capital buffers remain strong. The capital adequacy ratios for banks stood at 25.3%, for credit institutions, 20.1%, and for MDIs at 33.2%, and which is well above the minimums of 10% for banks, 10% for credit institutions, and 15% for MDIs, respectively. The capital conservation, the leverage ratio, which has a prudential minimum of 6%, and the capital conservation buffers as a proportion of risk-weighted assets at 12.5%. So all financial institutions met these minimum requirements. All, that is banks, credit institutions, and MDIs met those minimums with the exception of one. And the systemic risk buffer, which is an additional capital requirement on the bigger banks, and which ranges from 0.5% to 1%, all the domestically systemically important banks comply with their minimum. Profitability during the year, PAT, profit after tax, increased by 23.9% to 1.5 trillion for the year ending December 2023, from the 1.21 trillion registered in 2022. Key to note, much as were indicated earlier on, the structural risk has actually decreased. Most of this profitability was largely driven by the larger banks. And there's also been an improvement, slight, of the return on assets for the financial institutions from 2.79 to 3.19% as of December 2023, on a year-on-year basis. So our outlook or implication of this information, of this data, is that most banks continue to maintain strong capital buffers to absorb potential shocks. However, the high operational costs and the cost of deposits continue to affect performance of some banks. The next category of risks that we're looking at is market risks. There's been relative stability in the exchange rates. I know some of you might probably want to disagree with me because obviously we used to look at where the exchange rate is today and where it was perhaps a month ago. But we, as Bank of Uganda, we tend to take a long-term view. We're not focused on the immediate short-term view. So there's been relative stability in the exchange rate and interest rates during the quarter. All the banks may have complied with the net open position requirement of plus or minus 25%. The local unit, the UGX, remains stable against the US dollar, despite some pressures towards the end of the quarter ending December 2023. And the share of foreign currency denominated loans and deposits in the banking sector has actually reduced over the years. And that's reflected in the figure in the bottom left of your slides, where you'll notice the green dotted lines are Forex deposits, total deposits. The blue solid line is Forex loans to total loans, and you'll note that that ratio has been coming down steadily over the time. So the long-term trend is that it's been a downward, a reduction in that component. The real estate market, which in Uganda is rather important considering that real estate is the bulk of the collateral used within for the acquisition of credit. The residential property index shows consistent positive annual growth for the last 2 quarters, suggesting some recovery in real estate prices. Real estate loans increased by 1.5% and currently account for almost 20% of total gross loans. And there's been even a slight improvement in the NPLs associated with the sector from 6% to 5.6% over the quarter. That's from September 2023 to December 2023. The outlook is that this stability, this relative stability in the foreign exchange market and the recovery in the real estate market is expected to minimize credit risk and support more lending to the private sector. Bank of Uganda maintains a prudential loan-to-value limit of 85% for residential mortgages and land purchase loans, and this remains in place. Now let's turn to payment systems and performance broadly within that sector, performance and risks. There has been a growth in the usage of digital payments. On debit card payments, 9.1% increase in the quarter from 532 billion in September 2023 to 581 billion in December 2023. Mobile banking, an increase in the active number of users by 24.9%. Mobile money, volume of transactions increased by 7.7% over the quarter, and the value of transactions also increased by 2.9% to 62.2 trillion shillings as of December 2023. Again, you'll allow me to draw your attention to the figure you have on your slides in the bottom left of that slide, and take note of the increases, even those appearing apparently slight, on mobile money, internet banking, and mobile banking. So one key deduction from this particular figure is that increasingly financial transactions or transactions in Uganda and payments are largely moving to digital, which is something that we actually, as Bank of Uganda, are pushing for actively. Within the payments ecosystem, liquidity risk was rated low in the quarter ending December. All electronic money is backed by funds held in trust accounts. And bank accounts held at Bank of Uganda to facilitate RTGS transactions between the banks have always remained fully funded. Operational risk is moderate. If you recall the last presentation we had, it was low, but it's now moderate, so there's been a slight increase. That slight increase is largely because of the increased presence of the number of fraud incidents within this payment ecosystem. So in terms of outlook, Bank of Uganda continues to engage the payment service providers to address fraud and enhance their cybersecurity stance and health and hygiene. We've had a revision to the interception of communication regulations that came into force. This is expected to mitigate fraud activities with limits of the number of SIM cards an individual can own. And of course, Bank of Uganda will continue together with other industry stakeholders on public awareness and sensitization on the risks within digital payments. An update on regulatory developments. There was an amendment to the Financial Institutions Bill in 2023, which, and in particular the first one, which I'd like to draw everyone's attention, was the repeal of Section 115B of the Financial Institutions Act that had maintained the requirement for a Central Sharia Advisory Council at the Central Bank. And it was on the basis of this that Salam Bank was licensed as the first full-fledged Islamic bank in September 2023. Microfinance deposit-taking institutions, there were amendments to the MDI's Act, and these largely introduced and allowed for Islamic microfinance, agent banking, bank assurance for the MDIs. And at this time, Bank of Uganda is working on the implementing regulations for these amendments. The MDI Registered Societies Regulations 2022 and the supervision of large circles If you recall, in the Tier 4 and Money Lenders Act of 2017, I believe it was Section 110, there's a requirement that large SACCOs, those with capital of more than 500 million shillings or member contributions of 1.5 billion, are supposed to come under the remit of Bank of Uganda in terms of the supervision by Bank of Uganda. So these regulations were in effect, were to give effect to those particular amendments. So these were gazetted in June 2023. However, there's been a slight stall since there is currently a petition in court against Bank of Uganda, the Attorney General, contesting Bank of Uganda's large SACCO mandate. On environmental, social, and governance, ESG supervision, Bank of Uganda is working with the Bankers Association to develop an ESG framework. On ESG, which is environmental, social, and governance, Bank of Uganda is working with the Bankers Association to develop an ESG framework which covers, and one of the things we're doing is, first of all, understanding the state of play with regards to ESG stance by each of the financial institutions and the industry as a whole. The key factors or considerations we're going to take as an industry regarding governance, sustainable finance, the management of climate change risk and environmental risk, and of course, naturally reporting and disclosure on the ESG dimension. The other regulatory involvement is the financial institutions' liquidity regulations were updated and passed in 2023, I believe August 2023, and these are supposed to enhance the commercial bank's ability, the way they manage liquidity. So the regulations incorporate some of the standards from Basel III for LCR, which is liquidity coverage ratio, and NSFR, which is the net stable funding ratio, and an update of the list of liquid assets reflecting the financial sector's evolution. Under these particular regulations, in addition, the financial institutions are going to be required to conduct an internal liquidity adequacy assessment on every 2 years to ensure that the financial institutions understand and appreciate how they are managing liquidity risk, and also to give us a sense in terms of their understanding and management of liquidity risk on their balance sheets. And lastly, so the overall systemic risks continue to moderate during the quarter to December 2023. The banking sector remains stable and resilient to potential shocks, and this is largely underpinned by the strong capital and liquidity buffers that most of them hold. There's an expectation, there's a projection by Bank of Uganda for robust economic growth, and this was in our monetary policy statement that was issued earlier this month. And we expect it to alleviate the non-performing loans and foster bank sector lending to the private sector, as well as improve broadly profitability within the financial sector. In terms of the outlook, Bank of Uganda position is that over time, and based, of course, naturally based on data, there will be an easing of the monetary policy stance, and exchange rate stability are expected to support more accommodative funding conditions. So the outlook is for conditions in the banking sector to improve over the financial year 2023-2024. And as you're aware, with the statutory instrument that was issued in November or December 2022, the expectation is that all the banks, the tier ones, will have their capital, will all meet the minimum capital buffers of minimum paid up capital of 150 billion by June 2024. For the credit institutions, it will be 25 billion. And for the MDIs, it will be 5 billion shillings as minimum paid up capital by June 2024. So the policy measures and the stance taken by Bank of Uganda, and these are also reflected in the monetary policy statement that was issued last week,
We have started on the implementation of the financial institutions liquidity regulations. And as I indicated, that's about enhancing the banking sector's liquidity management and funding risk management, and also ensures that financial institutions in Uganda are aligned to international best practice and international standards. 2, we are maintaining our loan-to-value ratio of 85% on residential mortgages and land purchase, meaning that lending will not exceed 85% of the value of the collateral. And we're also maintaining our counter-cyclical capital buffer at 0%. The counter-cyclical capital buffer is where we expect financial institutions during periods of significant credit growth or profitability to increase their, or good economic conditions, to increase the amount of capital they are holding that later on they can draw down when economic conditions turn around and become bad. So, ladies and gentlemen, thank you very much. And I think Dr. Gesa will start taking questions if there are any. Thank you.
Thank you so much, Dr. Titi. A big round of applause for Dr. Titi for such a wonderful presentation. It takes an intelligent man to discuss the so many issues embedded in the presentation, such as macro risk, credit risk, market risk, among others. So thank you so much. But Doctor, there is, while I was interacting with the audience, there are about 3 issues that I imagine. 1, the issue of beneficial ownership. 2, we have some cases of fraud recently. So probably if you can throw more light on the role of BAU in managing that, because that is also another big risk that we need to be handling. But also 4, the recent minimum increase in the minimum capital requirement or paid up capital. So if you could start with that while the audience warms up with the questions. Thank you.
Okay, beneficial ownership. So the Companies Act was amended at the end of 2022, and regulations on ultimate beneficial ownership passed in January 2023. So the whole concept here, and this relates to our management, KYC, and the management of money laundering risk within the wider economy. The concept behind beneficial ownership is that every legal arrangement, it must be clearly identified who is the ultimate beneficial owner. In Uganda, within our Companies Act, the convention had always been that once someone was registered as a shareholder, the presumption was that the shareholder was the ultimate beneficial owner. What the regulations now require is that it's not enough for you to identify who the shareholders are. Even the ultimate beneficial owners must be indicated. And this deals with the fact that sometimes there are legal arrangements where they are shareholders, but those shareholders are holding the shares in trust or on behalf of others. So that requirement came in, I believe, in January 2023. I believe the URSB did issue some kind of timeline to companies to comply with this legal requirement. In about August or July last year, a number of corporate legal arrangements and companies were actually struck off the company's register for non-compliance with this requirement and other requirements under the Companies Act. And in turn, what the financial institutions have done is they have restricted access to accounts of those companies or legal arrangements that do not fully comply, one, with the beneficial ownership, but also with the filing and reporting of returns by these legal entities. So when we talk about beneficial ownership in Uganda, largely it's about, one, it's an advancement on your standard KYC, that any legal arrangement, corporate entity, or legal person, the ultimate beneficial owner, those that ultimately stand to benefit from the activities from the activities and the business of that entity are known and listed. Now, I'll turn to fraud incidents and the role of Bank of Uganda. In the presentation, I showed that there was a significant increase in fraud. There was an increase in the fraud incidents across the industry, not just within the payments ecosystem, but across the whole banking industry. And that's why in the risk categories, if you remember operational risk, it was amber with an upward-looking arrow. Amber is a bit moderate, but increasing. The role of Bank of Uganda, and going back to what the Director of Communications said, is about financial stability. Now let's take for a minute and pause and think about what really banking is about. Banking and the entities within the banking sector are largely in the business of selling trust. And fraud tends to erode trust. And to that extent, the fact that fraud erodes trust, Bank of Uganda is beholden to get involved in the management of fraud. One of the things Bank of Uganda is doing, and soon we shall provide cybersecurity guidelines to the financial institutions in terms of how the minimums we expect of them in terms of how they manage, in particular, cybersecurity fraud. Because we noticed that the majority of frauds are largely out of the increased digitization. So as we increasingly go digital, it has its upsides, which is the ease and the speed at which we transact or conclude our transactions. Because that's done online, it means nefarious actors or those actors who have otherwise, not good intentions, tend to take advantage of persons that are not careful in the way they conduct their transactions online or through mobile banking. So the role of Bank of Uganda, one, is we get involved because fraud erodes trust. And the way we are doing it, one, we shall be issuing the industry with cybersecurity guidelines in terms of how they manage cybersecurity risk or fraud risk. Two, when financial institutions submit their internal capital adequacy assessments, I will require them to look at the various risk categories that they face as part of the operations, okay? And then the question then is asked, for that risk category, fraud risk, what mitigants do you have in place? And for any residual risk, what kind of capital are you holding in the event some of this fraud risk materializes? So it's a two-pronged approach. One, guidelines on how you manage fraud, especially that from cybersecurity. But two, a discussion on how much capital you hold as a bank in the event that this risk materializes on your balance sheet. Third, I was asked to talk about the minimum paid-up capital requirements. So like I said earlier on, the statutory instrument was issued in December 2022. And as of June 2024, the Tier 1 banks are expected to have 150 billion shillings as paid-up capital. The Tier 2, the credit institutions, 25 billion. And the MDIs are 5 billion shillings. Now, for the institutions that have not yet met that requirement at this point, they have all submitted what are called capital restoration plans in accordance, I believe, with Section 82 of the FIA. What that does is that a bank gives a very clear timeline and plan in terms of how it intends to mobilize that capital and ensure its compliance with the fixed deadline, which in this case is June 2024. Ladies and gentlemen, at this point, I'm glad to note that all financial institutions are on course with their capital restoration plans. And we monitor this quite closely. Actually, a number of them actually file monthly reports in terms of progress reports and how they are on this journey to ensure that they meet the minimum requirements under the law. Thank you.
Thank you so much, Dr. Titi. One quick takeaway from your presentation is that all supervised financial institutions are on course with their capital restoration plans. So ladies and gentlemen, we are going to take questions from the audience, but I want to also inform you that we have other people following us online because this is a hybrid symposium. We have people attending via Microsoft Teams. We also have people attending via YouTube. So for the online audience, please post your questions in the chat room, and then we'll be able to read those questions. But also, it is to mention, or Dr. Titi, to mention that there is a bigger team from Bank of Uganda which is here to support you in the Q&A session just in case you choose to delegate. Director NBFI department represented, it's the director substantively, Mr. Ivan Amagaragariho, and Director Economic Research Department represented by Elizabeth Kasekende, Director National Payment Systems Department represented by Mr. James Bukulu, and then Director Financial Stability Department represented by Ibrahim Seranja, and then Director Communications, Kenneth Egesa. So Kenneth, Ibrahim, James, Liz, Ivan are here to back you up. So without much ado, we have the microphone, and Ralph Akorabirungi is going to be helping us move the microphone. In case you have any question, please put up your hand. You can as well write it in case there's already one written one, which I can give to Dr. Titi.
I can write.
While we get people to put up their hands.
Speak.
I can speak.
It will be quicker.
Okay.
Please.
Thank you for your presentation, Dr. Titi. My name is Rachel. I'm from Makerere University Business School. I noticed that and thank you for the tremendous work you're doing at the Bank of Uganda and the contribution to economic development in this country. I observed that where Bank of Uganda is undertaking or aligning itself to the Basel III Accord. And yet we know that globally, Basel IV is underway. What is the plan? Because we know that Basel III enhances resilience and addresses those gaps that Basel III has and the weaknesses regarding accuracy in risk assessment, as well as capital adequacy, which is also the focus of the bank now. I'll appreciate your enlightenment on that and the plan to adopt Basel IV. Thank you.
Yes, I'll address that one first. So yes, indeed. At this point, first of all, I would like to note that Bank of Uganda is fully compliant with Basel II. From Basel III, what we have taken is those aspects of Basel III that are more applicable and relevant to our economy. In understanding the Basel standards, one needs to be aware that they are largely developed for the large, what are called GSIBs, globally systemically important banks. So there are aspects of Basel III that might not be applicable for our less complex, unsophisticated banking system. However, we do pick those aspects that are relevant to us. Yes, indeed, there's a move to Basel IV, because you will notice most Basel Accords tend to be revised after significant world events. Basel IV is largely a response to what came out of the COVID period. So under Basel III, that's what we talk about, the liquidity coverage ratio, the net stable funding ratio, and the requirement for internal liquidity adequacy assessment by the financial institutions. With time, we will keep on looking at the various aspects of Basel III and see what else applies to the banking sector as the sector evolves and perhaps takes on increasingly more complexity. But also more importantly, I think we need to note, when it comes to Basel III, and rather Basel III versus Basel IV, is that in April this year, the Basel Committee on Banking Supervision will be circulating or providing or publishing the most recent revised banking core principles, okay? And I'll give an example. One of the core issues, one of the issues in there, in those revisions, those updates, that is kind of tied in towards what is going to appear in Basel IV. That is the matter of, one, how we define concentration, and two, introducing the concept of operational resilience. Okay? Normally in operational risk, we talk about business continuity, the ability for you to continue doing business in the event or there's a disruption. But operational resilience is where we are looking at an institution continuing to provide the core services it's required to provide in the face of either geographic or natural or non-natural disasters. The question is, does Bank of Uganda have any guidelines to ensure Ugandans and SFIs are protected against this new AI-generated fraud? No one can protect you against technology. Not Bank of Uganda, not UCC, not NITA-U, not the government of Uganda. What you do is you protect yourself by making yourself aware of the things and the technology you are using. Before I answer this question, I just want to ask a very quick question here. How many people in this room have bought a new phone in the last 1 year? Just put up your hands, by show of hands. 3 people. How many of you 3 actually read the manual that comes with the phone? None.
It's too complicated.
Okay. If the manufacturer of the device thought it necessary to provide you information on how to use it, and in your wisdom, after spending 3, 4, whatever million shillings they are to acquire this device, don't think it's necessary to acquaint yourself with those details. Do you have a right to complain about fraud if someone uses that device against you? Because in those manuals, there is always detail on how to protect yourself and protect your device. We now come back to this question, this gentleman or lady, most like a gentleman, but this question has been asked. We can't protect you against AI-generated fraud, but we can arm you with information on how to protect yourself on the technology you use. Okay? This is my friend here. I believe you're aware of something called the NIST framework on cybersecurity. There's certain key principles. It's about identifying your risks, assessing them, protecting yourself, and then recovering from them. For every time that you use technology, especially one that is over the internet, you are at risk. So if you first acknowledge that every time you interact with the internet, you're potentially at risk of being either hacked or someone misrepresenting themselves as you over the internet, the focus now comes back to you. What is it are you doing differently in terms of how you interact with that technology? That requires behavioral change. What Bank of Uganda can do and is going to do and is doing is on ensuring that the financial institutions that we regulate have what a cybersecurity hygiene environment that minimizes the risks of those kind of attacks on their customers and on the banks themselves. But even more important, those same cybersecurity guidelines as I made reference to earlier on, will place a greater emphasis on how the financial institutions recover after an incident. The reality is, fraud and cybersecurity will always happen. I think the more important thing is how quickly do we identify it, respond to it, and recover from it. And I think that's where the focus of Bank of Uganda can only be.
My name is Badrun Tege. I'm a Private Sector Foundation Board. Doctor, thank you for the presentation, and I like where we're going from the banking sector. But I do seem to feel that the stability is there, but we seem to have paid a price on growth in terms of the penetration of banking services available to the population. If you look at what's happened a few years back, the digitization came in. We've seen closure of banks, branches, and the opening of the agency places. So it's a transaction level of the business. And so at less than 15% of the population with accessible to banking, and then the services being minimized. If you look at the policy point in terms of maintain loan to value limit of 85%, we have less than 1 million titles in this country. So the amount of people who can borrow properly are less, which goes to what we see in terms of the number of lenders and the tier 4 players. And that doesn't make financial access. We did do a lot of work in terms of financial inclusion. And my point is we need to redefine what it means. It doesn't mean that I have a mobile money account. It means that what else can I get in terms of financial services? The other thing I see happening, and we're not looking at it, is the insurance sector. We talked about quality of assets that the banks are holding. If you look at how many young people are trying to get into the economy, buying cars and going to borrow a vehicle, and 85% of our vehicles are third-party insurers. Third-party insurance most times covers the third party, and that third party if somebody loses their life. So that's an asset, an investment of a young person that is totally not covered. So as much as we're talking about the insurance sector, I think we need to actually find a linkage there. And that's key to what we're trying to achieve in terms of growing the economy. So really there's that tight balance between growth and risk, and we need to find that balance to enable growth. A lot of young people today are locked out. Yes, they do have a mobile money account, they have a salary account, but there's absolutely nothing in the financial sector. So my ask is now that we've stabilized, we have strong banks, and it's seen at the profitability level. But that profitability level is at the risk of growth in terms of service provision. It is a monopoly. So yes, you're going to grow the profits because we've maintained and closed that space. But what are we doing to make sure that we grow? Banking services are wide and open to more people. I think less than 5 million bank accounts is really time for us to actually figure out how we change that. We have 20 million plus mobile money accounts. If those people could borrow equitably, I think we'd have a stronger economy. Thank you.
Thank you, Mr. Ntege. I'll go back to something I said earlier on. Banking is about trust, okay? Now, as a financial sector regulator, there's a balancing act. I agree. Do I grow the financial sector at the risk of deteriorating or reducing the level of trust? Because people will only, it is kind of a circular argument, and it circulates ad infinitum. If there is less trust in the financial system, they are less likely to join that system, okay? But when you enhance trust, sometimes the downside of that is that there are restrictions that kind of inhibit more people joining the financial system. It's almost a chicken and egg. But then, in further analysis at Bank of Uganda, and there'll be a study that will be coming out later on to understand pricing within the financial sector, is that we realize that this balancing act can largely be managed in one way, and that is reducing significantly the amount of information asymmetry within the industry. And this is what I mean. Every time, as a borrower, you stand in front of a credit officer, the credit officer needs to have some objective way of assessing your credit worthiness, okay? Within the current financial system, our focus has always been on the capacity to repay. The softer test should be about the willingness to repay. So a credit decision should be made on two things: your capacity to repay and willingness to repay. So now you make reference to the young people who have got jobs, and they've got salary accounts, the 20 million mobile money accounts. The easiest part to assess is their ability to repay. Their willingness to repay is where the information asymmetry is. Now, what Bank of Uganda has done in, I believe it was September, I will remind you, September or August 2022, we amended the Credit Reference Bureau regulations. And this is what's going to happen. And for a minute, just listen to me out. Is that, one, we are moving away from the FCS card to using the National Identification Number as your credit identifier. One. Two, we're expanding the universe of entities and persons that can provide information to a CRB and that can get information from a CRB. Three, we're moving away from credit reports per se to a credit score. What that then means is that how a person uses their credit, whether it is to a utility company, car dealer, hardware store, whichever entity has signed up, okay? All that information, which currently is not available to the CRB, is used to compute your score. On the basis of your score, a financial institution or a credit provider, it doesn't even have to be a financial institution. It can be, I don't know, be a hotel or something, can provide you credit on the basis of your score. In other words, what the regulations are introducing is the concept of reputational collateral. That I don't have to have physical collateral for me to qualify for insurance, whether you're paying insurance in the monthly installments as opposed to once a year, whether it is I seek a loan or an overdraft in a bank, or whether a landlord will allow me to rent and not pay a security deposit. Reputational collateral, that will be a score. So what the regulations are doing, that's what we're introducing. And I think recently, towards the end of this year, we actually issued a directive where we are stopping the issuance of FCS cards. We're migrating to the NIDs. That addresses the issue of saying, if I want to be able to access certain financial services, if I want to access trade credit, even as a businessman, the way I have used credit in the past across a whole dimension of industries or sectors is represented by a score. And that score then determines whether or not, say, Mr. Ntege and his company, your consulting company, will provide me services on credit or not. And I think that's the first step. That's dealing with the information asymmetry. Now, on the issue of insurance, again, under something called the Financial Sector Stability Forum, which brings together all financial sector regulators, there's a coordinated action to ensure that when one of the members is introducing certain innovations or regulatory developments, it should not adversely affect the others. The initiative brought into place by the CRB regulations, which, by the way, were consulted upon by all the sector regulators, means that we're now going to have one uniform place where your credit score is going to determine whether or not a car dealer will allow you to pay in installments, whether or not an insurance company will require you to pay the insurance premium for the car a year in advance or allowed to make monthly payments, whether or not a landlord will choose to interact with you or let you rent you their place, whether a business will provide you with trade credit or not. So that is what we are doing. It takes a while. There's going to be, and we'll probably be coming to PSF, by the way, on some of these things. There's going to be a significant amount of public awareness to be done to remove and address the issue of the information asymmetry. I don't know if, or have I raised more questions than I have answered?
You have generated a lot of interest, Dr. Titi.
Doctor, thank you. The information asymmetry point, I like, and I think you mentioned it last time at the symposium about the referenced. We have the majority of lenders in this country today are tier 4 microfinance, small lenders. Now, for them to actually be able to get a report is easy. For them to actually be able to update, they need a PhD. Because the way the system has been designed, it's amazingly complicated for a tier 4 lender who would like to actually be able to have that data because it's valuable to be able to utilize that data. And I'm sure if you do that straw code, you probably find less than 5 able to do that, right? So now that bit is breaking the information asymmetry conversation you talked about. And I think usually those are the minor details. It's a good initiative. It helps in terms of creating future lenders, future borrowers, but we need to actually be intentional on how we put it in place. So right now, the tier 4 plus lenders should be able in 2 or 3 steps, and the technology enables that to happen, to be able to update a record. It shouldn't take a PhD for that, but right now it does. And you've still not touched the insurance, because I do believe BOU has a responsibility to work with the Insurance Regulatory Authority to make sure that insurance works for Ugandans. It doesn't work, right? And we need to make sure that it does work for Ugandans.
Yeah, on the matter of insurance, I wish we had someone from the Insurance Regulatory Authority here. I would not want to be overstepping the mandate of Bank of Uganda. But like I said, we do work together with the Insurance Regulatory Authority. Now, for example, now that we have licensed an Islamic financial, full-fledged Islamic bank, the Insurance Regulatory Authority already has something called Takaful regulations for Islamic insurance. So there's a bit of, we're kind of syncing our activities in terms of how we do this. Now, on the reporting, again, why does the regulations were passed in 2022? We're now in 2024. We are still working out those minor details, those operational details in terms of the reporting. Because we know, for example, what incentive does a landlord have, for example, to send information about their tenant? Why should even a landlord want to ask for a tenant's credit score before they make the decision? Especially if his or her house has been empty for a whole year, okay? And that's why there's going to be a concentrated public awareness, and we're starting with a few sectors, largely utility companies, a few other larger purveyors of fast-moving consumer goods as a starting group, and then you slowly spread it out. And remember, most of these other people we're talking about, other entities, are not even regulated, so they don't even have a regulator who can make it a licensing requirement. Okay? But if we sit and say with the telcos and the large fast-moving consumer good companies and the utility companies, and they get on board, then with time we'll build up a critical mass. So that's the issue. Now, with time, the reporting process shall be simplified. Because like I said, if you are a landlord, why should you go through 12 steps to report on a tenant? Especially if he's paying on time, But if the process is simplified, and I think even this discussion has been had even around mobile money transactions and other digital transactions, to try and minimize the number of steps. But here's the problem. When you minimize the number of steps, there is what we call in finance the fat finger risk. Okay? That I might accidentally press the wrong thing and I don't have a chance to cross-check my input before I finally submit it. So there's that balancing act.
Thank you so much. Thank you, Dr. Titi. I have learned to call you. I knew your name as a longer one, but now I have a better way, as advanced by your colleagues. My name is Dr. Bill Nketo, the Dean Faculty of Business and Management at Victoria University. Just have a bit of worry about the government borrowing, especially domestically, because we know that crowds out the private sector. Now, by all standards, it pushes up the interest rates. So probably you've already catered for it indirectly. I just wanted you to just point out a few things to enlighten a layperson like me who is not into backing regulations. Then, of course, the borrowing continues with the non-concessional loans, whether internationally, and that also affects the way things have to be done. Of course, this has pushed the percentages beyond the threshold by almost 3 points. If it's the debt to GDP ratio is at almost 53%, if I'm not mistaken, compared to the 50% required, probably there is a way that is affecting the regulatory role as well as the supervisory role. And I have this feeling, probably when you're making assumptions about the way, because I pointed out here, the interest rate grew at 5.1% compared to the 8.6 in the other year. That means some of these things have something to do with these issues. So probably if you highlight a few things on that, probably to hope a lot, but I have this feeling that the resilience potential you talked about is catering for some of these things, but you just wanted a few highlights on that. I appreciate. Thank you so much.
Fortunately, we have the Director of Economic Research in this room. Dr. Elise Kaseke will address that question.
Now, to answer that, it is true government borrowing does crowd out private sector credit, but what you need to note is that government is currently committed, basically in terms of fiscal consolidation. When you look at fiscal deficit as a percentage of GDP, government is committed to reduce that. And also, when you look at, you mentioned about private sector credit, why it's not as high as it used to be in the past. Obviously, the high interest rate was one of the reasons. The other reason was the fact that banks were afraid to lend to borrowers who had a high risk. But as you note, Dr. Titi has presented that when you look at, in terms of the interest, when you look at in terms of the interest rates, when you look at monetary policy, we reduced interest rates in August, and we kept interest rates at 9.5 in the latest MPC round. But if we see that the global factors get better and we see that the conditions, the risks get better, then there is hope for reduction in terms of that. And also, I think the other thing that's key is non-performing loans. Dr. Titi presented the non-performing loans reduced to, I think, about 4.7. So that caters for the part that I mentioned in terms of the risk. So if non-performing loans are reducing, then you'd also expect private sector credit to start picking up. If interest rates are reducing, then you'd also expect private sector credit to start picking up. And also the fact that government is committed to fiscal consolidation and reduce domestic borrowing, that should also enhance growth in private sector credit. So I hope that answers you. Thank you.
And just to add on, besides the part of government borrowing, there is also another initiative government of Uganda has taken on from a fiscal perspective. The Minister of Finance and URA have something called a revenue mobilization strategy. And if as designed, if it even achieves 70 or 80% of what it's intended to do, then the gap or the need for continuous government coming back to the domestic sector to seek financing will be removed.
Thank you so much, Dr. Twinemans. We are going to take stock of the feedback coming in from people attending online before we come back to the room. Prosi Nakayiwa. Thank you so much, Doctor, for the presentation. Kindly highlight for us how long it takes to acquire a bond after applying for it and depositing money as agreed. Dope Media Uganda, maybe I'll just take stock of all of them and hand them over to you, Doctor, for ease of reference as you respond. Dope Media Uganda, could you please talk about your circular on early loan repayments? It seems banks are ignoring this directive. Descon Sevuma, why does Bank of Uganda close doors for foreign investments? Then lastly, Doctor, this is a thank you note from Mohozi Eugene, who says thank you so much for the wonderful presentation. I hand over to you, Doctor.
To Eugene Mohozi, I would like to say you're welcome. I believe that's a vote of thanks and affirmation of the work we do at Bank of Uganda. There was the issue of, someone asked, why does Bank of Uganda close doors for foreign investment? I don't know if anyone at Bank of Uganda is a trained carpenter, but I don't know what that question exactly meant, close doors for foreign investment. I don't think we'll be accused of that when we look at the fact that out of the 34 deposit-taking institutions that we have in this country, I think 28 are largely foreign-owned. If we were closing doors to foreign investment, I don't think that would be the case. Second, and in one of my presentations here, we're talking about capital inflows from institutional investors outside of Uganda and how that affects liquidity within the system and the exchange rate. If we were closing doors to foreign investment, would not be letting that money in. So I'm not very sure what that question is about. How long does it take to acquire a bond after paying for it and depositing money? I don't know what to say. I would presume once you pay, you get it. I believe the settlement is T+2. Yeah, it's T+2. So I think within 48 hours or 2 working days, you should be able to have the bond acquisition reflected in your investment account. Early repayment directive not being honored. The gentleman that sent this, or the lady, I would like you to give me an example of which particular bank that is, because that was very clear. And the purpose for that early repayment was, in any growing economy, if I have borrowed at the rate X and I find someone willing to refinance me for a lower rate, it's purely a business decision. And I should not be penalized for that. And in any case, when you look at the history of early repayment charges, they tended to apply for situations where borrowers were dealing with fixed rates. So if I borrowed at the fixed rate for a long period, the bank can then use those expected cash flows, repackage them as an asset-backed security and resell it to generate more liquidity. So if I pay early, I'm basically disrupting a whole plan. But our environment here is a variable rate, lending environment. So the concept of early repayment doesn't quite make sense. So all I can say is it is unfortunate if there is an institution, but if you could share with either me or anyone in Bank of Uganda an institution that has done that or that is not obeying a very clear directive, then we'll apply Section 80 of the FIA and make sure we'll hit them where it hurts.
Thank you. Now let's take feedback from the physical attendees. Ralph, okay.
All right, thank you very much. My name is Dr. Catherine Wanjiku from Uganda Technology and Management University Business School. Thank you very much for a very good presentation, Dr. TT. And my question is, where does Bank of Uganda face itself within the East Africa region? How is the Uganda shilling behaving in relation to their weakening neighbors in Kenya? Are you feeling you're doing better now? What's the reaction? My second question, managing fraud with ease of visa entry in Uganda, how are you managing the fraud in terms of cross-bank operations? Thank you.
Again, the Director of Research will address the issue of the Uganda shilling versus Kenya shilling performance. And on cross-border fraud, I'll say that under the Monetary Affairs Committee, the MAC Committee, which brings together all the central banks in the region, there is, I believe, maybe you speak to it, Ibrahim, there is a committee, or there was a working group focused on coming up with some kind of standard in terms of reporting and information sharing with regards to fraud incidents across cross-border incidents. Liz?
The Uganda shilling has been performing quite well in the past in comparison to the neighbors. And even during a time period where we saw the different currencies depreciate against the dollar, the Uganda shilling was actually relatively stable. It's not until recently, the last few days, that we're seeing the exchange rate depreciate, mainly on account of demand from like the energy sectors, manufacturing. But overall, if you note that, I think in part because of our monetary policy stance, when we had, when we increased interest rates, that in a way helped stabilize the exchange rate. So to answer your question, in relation to Kenya, and not just Kenya, even within the region, our neighboring countries, the exchange rates, the Uganda shilling has performed relatively well compared to its neighbors. Thank you.
And just to add on the Uganda shilling, Kenya shilling, the policy stance of Uganda is, when it comes to the exchange rate, our focus is on managing volatility. So we are not concerned with where the level is or the direction of the exchange rate, whether it's up or down. Our focus is on that we manage volatility. And that means we try to avoid significant, what I call discrete jumps in the pricing, but we want it to be a smooth change in the exchange rate, whether it's going up or down. And I think that's the fundamental difference, I think, for Uganda and most of our neighbors. And I think even the majority of the countries within, across Africa.
Thank you, Dr. Twine. Please unmute the microphone and submit.
Thanks, Dr. Twine Manzi, for the presentation. My name is Tadeo William Senyonyi from Business Focus website. My concern is about the minimum capital requirements. What are the implications of the increased minimum capital requirements on SFIs? Are we likely to see more mergers and acquisitions because of this? Why I'm asking this is that when you look, for example, at the commercial banks, the market is mainly dominated by about 10 banks when you look at the key performance indicators. Also in your report here, you clearly state that the profit as of December 2023 was driven mainly by the largest banks. When you look at assets, you find the number of banks that whose capital, assets is less than 500 billion, others below 100 billion. So I would like to know from you, what are the implications of this on banks as well as the entire banking industry? Thank you.
To address your question, I think let's go back and try and understand. Why did we push for an increase in the minimum paid-up capital? Not necessarily an increase in ongoing capital requirements, what we call the capital adequacy ratios. Paid-up capital of a bank or an institution is money that is invested and is not available to the shareholders for distribution unless after or during resolution. Okay? So basically think of it as its skin in the game, so to speak. Now, let's go back and look. The conversation for minimum paid-up capital began around 2019. COVID what we went through during the COVID period, just merely reinforced the need to have that every bank must have a certain minimum amount of money, not available to the shareholders to distribute as dividends down the road, but money that is committed into the institution as a buffer for you, and as a resilience buffer, so to speak, to absorb any shocks or adverse developments within the economy and the bank's ability to remain a going concern. Now, if that was the motivation, what do we think the impact is going to be? One, for the banks and the institutions that meet this minimum paid-up capital, it increases their ability to remain going concerns even in adverse economic conditions, which is what we're interested in. Remember what I said at the beginning, and I'll keep on repeating it. The business of banking is the business of trust. And you cannot trust a bank or an institution that's on shaky ground. So the first thing is, we think of it this way as setting a baseline to the level of trust you can place in an institution by mandating that it holds a certain minimum amount of capital, which capital is not even available to the shareholders of that institution, but is available to the institution in the event of shocks. So that's the first impact. Increase the ability to be resilient to shocks. The second, and you're talking about the big banks, you will notice that the big banks, big by balance sheet, have also got increasingly large amounts of capital that they sit on. When you look at banking, you can only lend and do business to the extent of the amount of capital you're holding. Okay? The more you grow your capital, the more the business you can do. And under the prudential requirements, for example, in Uganda, we have something called the single obligor limit. So to minimize concentration risk or the risk of one borrower affecting one institution, we cap the maximum exposure of one person or borrower to a bank to 25% of its core capital. Okay? And the core capital is basically largely its paid-up capital and the share premiums. Okay? Now, if you have got a small capital base, it means that when it comes to lending, you are capped by how much you can lend to different individuals. Now, companies are growing, you'd expect the banks to also grow too. That's one. Two, let's look at the credit needs of the economy, both now and projected over the next 5 years. Let's look at the oil and gas, OGI, oil and gas industry. With an enhanced or larger capital base, it means that most of these infrastructure developments, most of the lending we require in this economy can actually be generated internally as opposed to externally. Because when the lending for companies in Uganda comes from outside, there's less revenue earned by the government of Uganda on that interest income. Okay, the interest income is expropriated tax-free. But when it's generated here, it actually has a multiplier effect if it is generated from, it's lent from internally generated funds. Do we expect to see increased merger and acquisitions? I mean, that's entirely a decision of the shareholders of those institutions. What we have seen is that some institutions have since sat down and reviewed and reconsidered their business models and decided maybe perhaps this is not a market they would like to be in, or it's a market they would like to be in but want to focus on a different niche. And by having different capital requirements for different categories of banks, it enables those who have refocused their business and business strategies to have the capital requirements for the sectors or the niches they want to serve. So, do we expect mergers and acquisitions? We've seen a couple of acquisitions. There are a couple in the pipeline. Mergers, I don't know. But again, that's going to be determined by demand and supply. Let the market decide where the most efficient form is for certain banks to merge and become one entity and make themselves competitive, or to sell out to other entities that have a better place to take advantage of the opportunities in the financial sector in Uganda.
Bloomberg, please unmute the microphone and ask your question. Okay, let's yes, Doctor. Okay. Oh, the gentleman with the microphone, just, okay, thank you.
My name is Fred Ojambo. I work for Bloomberg. By what margin is the aggregate assets of the banking sector expected to grow this year? And for last year, how does the total assets of the banking sector compare with the highest ever, if at all it wasn't the highest ever? And if it wasn't the highest ever, when was it at its peak? Then you talked about easing of the monetary policy. When should the market expect this?
Well, Mr. Jambo, fortunately for me, all your questions I don't have to answer. I'll ask Ibra, the Director of Financial Stability, to address the issue about expectations about the growth in the aggregate assets, and on the issue of when we shall start seeing an easing in monetary policy, the Director of Research shall address that question.
Thank you very much. So I'll address the question on asset growth in the sector. And I think this was partly touched on in one of the slides. Last year we saw a growth of about 9.3%. I think the prior to December 2022, it was about 9.1%. So we're seeing a return to pre-COVID levels of about 10% to 12% range, which was normally the range. But I'm glad to say that we continue to see sustained growth going forward, and also even on the deposit side, as was touched on in one of the slides. So the banking sector continues to grow, and we expect even better growth as projected, as the projected growth also picks up. Thank you.
Thank you for that question. Now, to answer the question in terms of monetary policy, when is the bank going to cut rates? As I mentioned earlier, right now we have risks to inflation. Maybe let me just try to explain how this works. We usually have inflation forecasts, okay, that we look at, and all other information, we look at the risks to the inflation forecasts, and then we make a decision in the Monetary Policy Committee. What decision should we make based on the information that comes in? And currently, we chose to keep the CBR at 9.5%. When are we likely to reduce that? That depends on the information that comes in. We'll need to look at the risks again and see some of the risks we mentioned. Looking at oil prices could go up given what's happening in the Middle East with all the wars that are going on. Also the exchange rate depreciation. Those are some of the risks that are still obvious, but if we see that those risks reduce and our inflation forecasts change, then it's possible to reduce the interest rate. But for right now, given the risks, the central bank decided to keep the CBR at 9.5. Thank you.
Okay, the greatest risk that the central bank is seeing, internally and externally. In this presentation, there's something missing. I was trying to look for it, open. I didn't find our current reserve level. Well, I've just missed it. I'm not seeing it. I'm not seeing it there. And then when I looked at the share of foreign credit loans, I think it has somehow gone. You mentioned it has reduced. Oh, it is reducing. What is the reason? Has it become so expensive, or people are just fearing to go and borrow in the foreign exchange because of the dollar rising? And then let's go to the payment system. I looked at the growth of the deputy, very nice. But my question is, the last time I saw, you had licensed about, is it 27 by then, service providers? And then somebody asked, when we presented the story, then they asked, is the central bank willing to continue or they'll put a threshold? Will it continue, or you are going to put a threshold of that? When we come to, let's just go back to what has been asked and maybe again refine it and ask it again. Doctor, when you talked about frauds, really, what is really behind this? Is it human-driven, or it is just electronically driven? There must be something behind it, really. Or people just, there's just some kind of a loophole somewhere. Thank you.
On the issue of whether or not we are capping the licensing, I believe that's on PSPs, and I'll ask Dr. James Bukuru from the National Payments Department to address that issue. On the decline behind Forex loans, I'll ask Ibra, Financial Stability, to address those, and I'll probably supplement his comments. And the question I would like to address myself to is, what is the greatest risk? There was a chart. If you see, look at your slides on number 4. Slide 4. Those were the broad categories of risks. They have many sub-risks, but here's the problem. None of these risks is important on its own. They all operate in concert. So, if you ask me as Twine, what would keep me awake, it would be credit risk. But for someone else, it might be market risk, okay? For someone else, maybe perhaps the research department, it might be liquidity risk. All these risks tend to work and interact with each other. You cannot pick out one and say you worry about that without taking into consideration what other risks are doing to it or what it does to other risks. So there is no one particular greatest risk. And that's why when we talk about overall risk or systemic risk, we have a figure, we have a number, and you look at currently overall risk on the orange line is at about 0.4. But that figure of 0.4 is a result of looking at all the risks within the whole system. So my greatest risk in response to your question is overall risk. I'll ask Ibra to respond on the issue behind the decline in FX loans, and James Bukuru to talk about whether or not there's going to be a cap on licensing for PSPs.
So the decrease in Forex lending, I think, was reflected in figure 10. And it's a positive development that we've seen in the banking sector. I don't know, I'm very sure you've read around the issue with dollarization of economies. On our side, that figure reflects decreasing dollarization in Uganda, which usually is a problem that affects other countries. So it's a positive, and it has gone down over the years, partly because of prudential policy from the central bank. I think earlier they discussed how Bank of Uganda manages its monetary policy and foreign currency, which is commendable. So that speaks to the borrowers' trust in the Uganda shilling, so they are able to, they prefer, increasingly preferring borrowing in domestic currency because they believe the currency is well managed and stable. So it's a trend that reflects the market perception of monetary policy management and the stability of the financial system. And I believe that covers it. I'll let James take on the other question.
You asked about whether the central bank is about to put a cap on the payment systems that we license. This kind of reminds me of a story I think was told some time back about when should you tax if somebody's growing, if something is moving, should you reduce the speed or put a policeman to say, can you hold your fire or something like that? But for your comfort, Martin, We are seated at the central bank. We have several applicants that have come for licensing. The journey has just started. As you know, the National Payment Systems Act was enacted a few years ago. So we cannot put the brakes immediately after acceleration. So we are moving on. The moratorium issues are being discussed internally, and when the time comes, whether we should cease our fire, we should actually announce our decision. But even banks, by the way, are coming for licensing as PSPs. Even a bank that already has a license to operate a commercial bank can come to us and apply for our licenses. So, for your comfort, you can also come tomorrow and we'll give you a license, provided you meet the terms and conditions of the license. I hope I've answered you. Thank you.
Thank you so much, James. You can come for the license provided that you meet the terms and conditions. Now we have a round of questions, Doctor, that are coming in from our online attendees and others written from the physical attendees. The first one, from the report, you indicated that the reduction in non-performing loans reflects recovery on bad loans and write-offs. The question is, how much of the bad loans could we have recovered? That is Pedson Mumbere. Smart TV. I'll just read through all of them, then hand them over to you. Hassan says, since we are using the NIN as the unique identifier, what about the foreigners and refugees? What will identify them? And then Catherine Murungi says, thanks very much for the great presentation, especially about the credit scores. Considering that we're going to use national IDs, this will help us to have financial discipline. Some hotels, fuel stations, and other businesses have continued to add a surcharge on Visa/MasterCard transactions. Is BOU toothless to enforce its directives? And then finally, Proce, it's a follow-up question. The very last one from Proce, I applied for the bond in a certain bank, and it is a month now. Whenever I asked the branch manager, he says these things take time. Kindly help. Financial consumer empowerment mechanism in the communications department was set up to handle this. Proce, please reach out to us via fcem@bou.or.ug. We'll have that handled. Let me ask the doctor to do the last response, and then we close.
There was a question about the surcharge on Visa MasterCard transactions, and I'll ask James Bukuru from the Payments Department to address that issue. The follow-up of the bond question, the MC has been kind enough to share with the Proce, and he will probably try and get in touch with the Proce so that that matter is dealt with under the complaints handling mechanism at Bank of Uganda. So, on the issue of NPLs, yes, indeed, the reduction in NPLs partly reflects recovery on bad loans and prudent write-offs. Now, you're asking how much of the bad loans have been recovered. I don't think I think you're asking the wrong part of the question. I think the more question should be is, how does prudence in provisioning lead to reduced NPLs? Now, the prudence means that when the financial institution has made a loan and there is a what's called an SICR, a significant increase in credit risk, is a likelihood that the borrower will not repay on time or meet the terms and covenants of the loan. Because the loan has been made out of depositors' money, the financial institution should get money out of perhaps its profits or out of its capital and set aside to ensure that depositors' money continues to be safe, and then work out a mechanism with the borrower to recover the money. So when banks are prudent in how they write off, it means that they take the hit on their balance sheet, on their income statement or their balance sheet, and then work out mechanisms to recover. Unfortunately, this time I cannot give you a figure in terms of how much has been recovered, because the recovery process is part and parcel of the normal banking business. There was an issue of foreigners and refugees and IDs. The Registration of Persons Act 2015 and its implementing regulations of 2016, I believe, provide for documents, national issued documents for the identification of refugees and foreigners. For foreigners, there is something called an alien identification number, which is supposed to be issued by NIRA. I'm not very sure that NIRA has begun the process of issuing those. However, in the interim, when it comes to refugees, the Office of the Prime Minister, I believe working with the UNHCR, developed some kind of biometric system and identification, and they issue refugee cards. So those will be the identifiers that we'll talk about, or that shall be used within this new dispensation and the revised, the updated CRB environment. I don't know if that addresses the question.
Yes, it does. You asked James to respond to one of the questions, and then we close.
Yes.
Thank you so much. I don't remember whether, was it a gentleman or was it a lady who asked the question? Okay, it was an online question.
Surcharge on visa.
Surcharge on visa, yes. Unfortunately, the central bank does not regulate prices. Number one, we do not set prices that our licensees are supposed to charge. This is a free market. They are free market. This is a free market economy, and these matters are left. These are business decisions of our licensees that we license to operate in our economy. But I think I want to also dissuade you from saying that the central bank is toothless. We have an association akin to the UBA, where our licensees come and converge, and we always in conversation with them about pricing. So there's something called moral suasion. This is a big tool that Bank of Uganda uses. So we can talk to you nicely that can you please calm down on pricing. Okay? So much as we will not directly force you or turn your arm that can you come to 200 instead of 100, but we've got we've reaped some benefits out of these sessions. So we call them around a table and we discuss, chat over it, and we've seen that prices have gone down. There's something we are cooking, so it's not yet ready. We'll have what we call a national switch. So the switch will come to ameliorate the problems around pricing, because unlike other countries that have switches, Rwanda has a switch, Tanzania has a switch, Ghana has a switch. By the way, Ghana has went ahead to, they have a card. We don't have a national card. You've talked of Visa and MasterCard. Those guys come here, and because we don't have a national Visa card akin to a Visa for the country, so we still ride on their rails to drive our payments. So, moral suasion works. We have many tools in our toolbox. We keep pulling one at a time as and when we think it is appropriate. Thank you so much.
And just to supplement what Mr. Bukuru has said, with regards to this surcharge, I believe about 2 or 3 years ago, there was actually an announcement by the Bankers Association, Visa and MasterCard, with regards to surcharges, where you use the card, my understanding, where you use the card, you're paying a bill of 100,000 and they tell you, you need to add on an extra 3%. Now, MasterCard, Visa have all come out very strongly against this practice. If, and the MCs here, if that is reported, that merchant will get removed or delisted from the Visa platform with the MasterCard platform. So whenever those kind of incidents happen, I believe we have social media channels, we have email and another other means of getting in touch with Bank of Uganda. We will share that information with the Bankers Association and Visa, and those particular merchants or the banks that manage those merchants shall get delisted from the Visa and the MasterCard platform.
And ladies and gentlemen, that marks the very end of this third Financial Stability Symposium. Let's give a big round of applause to Dr. Twinemas Tumuboine. Thank you so much, sir. We'll allow him to go and take his seat as we invite Rita to come and deliver a vote of thanks to each and every one of us.
My name is Rita Uganda. I'm sure most of you saw my name in your inboxes. So on my behalf, on behalf of Communications Department, on behalf of Supervision Directorate, and on behalf of Bank of Uganda, would like to say thank you very much for choosing to be here with us. Thank you for braving the cold weather, for those of you that have been here physically, and for those that are online, thank you for investing your data in us to participate in this third symposium. We are very delighted and we are humbled. I would like to request you to kindly fill in your registration forms and the evaluation forms. We can only get better if you give us feedback, or we can do this again if we get feedback from you. So kindly fill out your evaluation form. And to the BOU team, to Ibra, Liz, Ivan, James, Ken, and of course, Dr. Titi. Thank you very, very much for making today happen. Communications Department thanks you very much for being here with us, for taking out the time. And to everyone that has participated, we do hope that the discussions have imparted new knowledge and we have corrected any misinformation that was there in the past. So we do hope to see you again if we call upon you once again to come and join us for any of the similar engagements. Please come through. Do not grow tired of attending Bank of Uganda events. We do have several of these, but they're only aimed at enhancing your confidence in us as your central bank and imparting new knowledge. So once again, thank you very much, and do enjoy the rest of your pre-Valentine's Day. Have a good day.